It's like doctors, you don't make that. Oh, I got the thing. I'm
Right.
done. So when
Right.
you go, oh, I just want to do a standard payment, and they go, what's my payment going to be? You're like, well, it's going to be $800 or $1,200. You go, that's what I make a month.
Hello, our lovely listeners and readers. We wanted to let you know we are moving our newsletter over to Substack, and we are very excited to now be offering a paid option on Substack for subscribers in order to get exclusive content. That exclusive content is going to involve both podcast and newsletters, and the newsletter will provide supporting documentation for those topic specific podcasts. Our objective with offering the paid version is in order to provide the listeners, you and the readers, also you, who are interested in a higher level of personal finance, the opportunity to find that within our show. Guest interviews will continue to be free as they have been in the past. And if you're interested in being a guest on the podcast, please let us know. We'd love to have you on. And we really appreciate all of your support in the pod over the last 8 years. So, this is our way to offer an upgraded, exclusive option for the podcast. So it'll involve dedicated episodes and also the newsletter where we're going to be doing more exclusive content and deeper dives on various personal finance topics in order to help improve the financial education that we're offering on the show. So if you'd like to check it out, we would love to have you. You can find more details on our website, www.futurerichpodcast.com. Welcome to Financials Podcast, Future Rich. I'm your host, Barbara Ginty, and I'm also a CFP, which is a certified financial planner. And I am here with my guest today, Katherine. Hi, Katherine.
Hello.
Thanks for joining us.
Thank you for having me.
Yeah. So, Katherine, you did a lot of homework, so I thank you. It's always helpful. So, I have a lot of information on you already, but our guests don't know anything, or our listeners, you're the guest, our listeners don't know anything about you. So would you like to give them a brief overview, maybe like income, age, all that jazz?
Sure. I am 48 years old. I am a professional, and I earn, I think, a fairly, a decent income for my profession. I am an airline pilot, and so I make just under. It's a joint income of just under $400,000. Just for myself, I range between 350 and 375.
That's great.
A year. Yeah. I'm very lucky, and we acknowledge how lucky we are. And we came from much more moderate beginnings, and so we acknowledge how fortunate we are in this position now. But
yeah,
now we are. Well, yeah. Thank you. And we're in a position now that we're starting to get our act together financially, and we want to make sure that the next step is where we actually want to go. And we're also experiencing a little bit of lifestyle creep, a little bit of, I think it's an opportunity where we know that we can actually afford some things. And so we want to do it. But I feel like we're, as crazy as it does sound, and it sounds crazy to us too, I think that in some areas we are still overspending maybe. Mm-hmm. And I don't know. I don't know. I guess that's kind of for you to hash out and lead me to wherever you want to go and to see things that you see that I don't.
Yeah, well, okay, so you are married, and how old is your partner?
They are 55.
Okay, perfect. And retired, right?
Yes, they're retired.
Partner's 55, retired, and then you have 2 children?
Yes, I have 2 children.
So ages, one in college and then a little one.
Correct. One in elementary and one in college.
Okay, perfect.
We do it one at a time, apparently, in this house. So we started over.
Yeah, go ahead.
I was just going to say we started over with the kids. We also have my mother-in-law who lives with us as well.
Right. So you got a lot going, right? We've got a young child, a college, and then an aging parent.
Correct. And the college one is almost out of the house. We still have them here, and, we'll have them as long as we can. But we have the older one in the house and the younger one in the house. So we call it the atrics, the pediatrics and the geriatrics is what we have in our house.
Intergenerational living, right?
We do. It's wonderful, but it's a lot.
Yeah. And then you are based in what area of the country?
Well, that is curious because of my career. Based in the Northeast, but
based in the Northeast. Right, because you can live You live in the South. Okay, so cost of living, we'll look at South for like expenses
Yes.
and those sort of things. Okay,
Yeah.
very cool. And then the interesting thing with your career path is that certain careers have mandatory retirement. So I just want to like point that out. So in a
Yeah.
lot of careers, retirement is up to you when you want to retire. And then in certain careers, like your profession, and like my uncle was a firefighter, they have set
Mhm.
retirement dates that are it's 65.
Correct. Correct. Currently at 65. Personally, I fully expected to go up to 67, but that is a personal guess at best. And right now it's 65, so that's what we have to work with.
Yeah. Okay. So we're cruising in on retirement. We're not I mean, we're far, but then like not terribly
Right.
far from a planning standpoint. Perfect. And then curious, did your husband have a government job? How did he choose to retire?
He did. He had a city job.
The reason I guess is because 55 and retired with a pension usually means some sort of
He,
government employment.
yes, yes, he started early, and when we got married, the income disparity was just so great, and him retiring allowed me to work more,
I was going to say
and so he be,
with a young child and you being gone, right? That
yes,
allows him to stay home with your 8-year old and he has the pension. Okay.
yes,
That was my guess, but I
yeah,
was curious when I looked at the age and the income and then your career with an 8-year old, it kind of I was guessing he probably
mhm.
had 20 to 30 years in on a government job, took the pension, and then that
That was
works.
it.
Okay.
Yep, that,
Yeah.
that was it.
Yeah, if you start a government job really early, like if you get your government job at like
Mhm.
22, you get 30 years in, you're 52. It's
Yes.
pretty, yeah, it goes pretty quick. You can be pretty young. And then government jobs, the nice thing is they have pensions. And so you don't have a pension. We'll get into
No, no,
yours, but husband has a pension, but you don't have a pension. Okay, so we have your income, a little bit about your current life.
no.
Let's start with income coming in and then expenses. You broke it down really nicely. So I think what I will say in your case is I don't think we need to go completely by line item, but
Okay.
so you are maxing out your Social Security. So for those who don't know, you only pay Social Security up to the wage base. So you max it out. So you bring home less in the beginning of the year when you're paying into Social Security. You bring home more on the latter half once you max that out. And so
Yeah.
you're bringing in, what was it, 19 to 21,000 a month?
Yeah, right around there.
Okay. And then
20.
go ahead.
I was just gonna say 20 is probably a good guesstimate. The minimum I'll bring in, especially towards the beginning of the month, is 17. And but then towards the last half of the month, I mean, the last half of the year, it tends to tick up quite a bit.
Pick up, yeah,
And
because
then
you're saving.
if I happen to hit something like overtime or something of that nature, it'll tick up also. But that's honestly that it'll happen twice, 3, 4 times a year max.
Okay, so we could kind of say on average it's about 20,000. And then that's with the pension, because your husband's pension comes in too.
Hmm.
You have your
Yes.
fixed expenses at 8,500 with you have really great interest rate on your mortgage. And
Mhm.
then your non-fixed expenses coming in at 4,300. So for a total monthly spend of 12,800. So we just say roughly 13,000 and we use the
Yep.
lower number of 19,000 of net income. You have about 6,000 in theory left over a month.
Correct.
Perfect. Okay, so let's talk. You have some like really interesting your components here. One of them is something I've literally never seen, and I've been in finance for 20 years almost at this point. 19, we'll round up and say
Round up.
20. Yeah, we'll round up and say 20. I've literally never seen this in my entire life. It's not even ever been in a textbook. So we'll
Wouldn't.
start with your assets. So you have a 401k match of 17% of your earnings,
Correct.
which is amazing.
It really is. Hmm.
I've literally never seen it. I've never seen it in a textbook. They've never given an example, even in a textbook, of where the company match brings you almost to the defined contribution limit.
Oh, yeah. I think it's kind of because traditionally pilots used to have pensions.
Pensions. That's exactly what I thought. Is they got rid of the pension and they just super increased your 401k.
Correct.
Yeah, because
That's
I
in
was
essence
in
my
essence
interpretation
what
of it.
they yeah, that's exactly what I was going to say is because traditionally your career where they have mandatory retirements, right? They generally
Hmm.
those jobs also come with pensions
Forever and ever, they have
and ever
always
and
come with
ever.
pensions.
Yeah. And so
Yes.
you
And it
don't
is
have a pension.
correct. I do not. So this is definitely a recent development, and it is something that has been negotiated, and it's been bumped up since COVID.
Oh, okay.
Um,
It wasn't, I was gonna say, it didn't appear that it has always been this high.
it wasn't, but it had always been, top of my head, I want to say 12%.
Okay.
So it was significant. It just got bumped up. And that is across, as far as I know, the majority of the major airlines in this country.
Right, because they got rid of the
So
pensions, right? There isn't a major airline right now offering a pension for a pilot.
we all compare everything. Everybody knows that everybody has.
Yeah.
So and so gets a percentage. Everybody else gets the same percentage.
Same
So
thing.
everybody generally, yeah, it's an industry thing, I believe.
Okay. Well,
Hmm.
it's great. So 17% of your earnings, we'll just use round numbers, works out to be roughly 60,000 that goes into your 401k as your employer match, give or take your earnings for the year because it's a percentage, so it's a moving target, as you said. Um,
Correct.
So then, for our listeners who don't know this, there is actually a limit on how much total monies that can be in a 401k. And the total limits for this year in 2025 is 70,000. So depending on where your earnings are going to fall this year, you're going to be eligible to put somewhere between 10 and 12,000 of your own money as a pre-tax contribution. And they should. Usually, what I will say, because you were like, I'm not sure, what they're supposed to do for you, the 401k company, whoever's administrating the plan, and I don't know if you've had this happen, is if you put in 12 and actually with the company match it, you should have only done 10, they should auto stop you. Like you should be able to have it elected and it should auto stop you from over contributing to the 401k. That's what they're supposed to do. Whether or not
I
they do
think
it, I don't know.
I think what happens is that because it is based on our income, if I contribute, let's say I contribute 15,000, my company, they won't know till December
Right.
what I earn, what they can match.
So they can,
So
if they're supposed to be like checking it technically, they're not supposed to allow an over contribution or they're supposed to remediate it. So I'm not exactly sure, but generally what we see with 401k plans is if you put in a percentage, right, and you've over
mhm,
contributed because you did the math wrong, they're supposed to auto stop it for you. Like they're supposed to be tracking the amount of dollars going into the plan.
yeah,
Whether or not they're doing that is the question.
they definitely do that when you get up to whatever it is, 23, 5, 24,000, the
But
contribution.
they're not tracking on the 70.
They're not. Because when I ask them, because I have gone through this conversation with them, I go, well, how much am I going to earn? And they go, well, we don't know. I'm like, well, I don't know either. So how do I know
Mm-hmm.
what 17% of it is? And they go, yeah, we don't
Yeah.
know either. And I'm like, well, can we use last year's numbers? They go, well, you can use last year's numbers, but we can't advise you on what you can contribute to your retirement fund. They just know at the end of the year, they add it all up and then they go, oh, you over contributed. And then they give it back to you.
So they give it back to you. So they'll do an accounting of it at
Well,
the end of the year. Yeah, and then they give it back.
until the end of the year.
Okay.
And one year I over contributed like 7 grand. And I was like, well, you guys held that for like 3 months. I should have stopped contributing like 3 months ago. And then it takes a month or two. So you held my money for like
And
six, 7.
they're supposed to give you back the interest it earned if it earned interest. So it's supposed to be like a contribution and the interest earned.
I do not remember that specifically because I remember being rather miffed that they held my money for so long.
Yeah, I mean, I would be too. I mean, they're supposed to be tracking it.
Yeah.
Okay.
But this was to be fair, this was several years ago. So
Okay.
maybe I am
Maybe they
not
got
remembering.
maybe they got better. I will say this is an unusual case. As I've said, I've sat with thousands and thousands of people at this point, and I've never seen a match so high. And I've met with pilots, but the older generation where they had pensions, right? So
That's
like not
interesting.
this. Yeah. And so it is possible the companies are just these plans are so specific where the company matches so high that they don't have like a safety parameter in there to say, okay, you've hit 70, then let's look at what's happening here on this account. But they're very good at making sure you don't over contribute on the 23,500. But okay, so you'll be able to
Right.
contribute somewhere between 10 and 12,000. And so what you're doing is just like looking at it in December and kind of seeing where you're falling.
I take a best guess based on last year's income,
Okay.
and then I over contribute a little bit to make sure
Okay,
that
perfect. That you hit it.
Yeah.
Okay, that's good. I mean, I think, yeah, you don't want to over contribute 7, but if you over contribute 1,000 or 2, they give it back to you. Yeah.
Yeah. Percentage
Okay.
wise, I mean, there's going to be a little bit of slop, but I will definitely follow that up and double ask them. I will ask them about that.
Yeah, see if they got any better at it. Because you can't be the only one who doesn't know what they're making, and everything is a
Right.
percentage. Yeah, no, you're not the only participant in the plan who's like, I don't have a set salary. I have overtime. And right, there's a lot of variables. And they always do percentages, which means the number is a moving target. Okay, cool. Well, that was like one of the most fascinating things.
Oh,
Yeah, so I thought that was very cool. I think our listeners will find that very cool. So in your 401k, you have $715,000. You then are also doing a backdoor Roth. So in your Roth, you have 65,000. So what you're doing is you're doing a non-deductible contribution and then converting it into the Roth. You have no other IRAs, so you're not running into the pro rata rule, which is great because
correct.
we do not ever want to run into the pro rata rule. And then have you done that
We just
before?
1 year. Yeah, no, well, we were aware of the pro rata rule. So 1 year we just bit the bullet and we just converted all in the same year
Oh, you
and
did.
spent,
Okay. To get rid of it.
yeah, and just bit the bullet on the taxes.
Yeah, you don't you if you have another IRA, it gets really messy real fast. And then you're doing what's considered a spousal Roth IRA for your husband
Correct.
because he's not working and you have income, so he doesn't need income for the contribution. And so because he's over 50, you can do 8,000 for him and you're under 50, so your limit is 7. So it's another 15,000. And then
Right.
I know you have money saved for one of your children, but I'm not going to count that because that's earmarked to be spent for the child.
Perfect.
Perfect. Okay. So in total in retirement, you have 812,000. And then let's talk about the debt. So we have a little bit of debt. Okay. So on a credit card, you have currently 38,000. Oh, the one other thing I'm going to mention is so you have an employee stock purchase plan, which you max out. The limitation is 25,000. You're able to buy your stock at 15% discount. So basically, it appears that you're buying it for the discount, selling it, taking that amount that was the discounted, which is your profit, and then taking it back out, not holding it.
Correct.
Okay, perfect. So you make a little bit of money there as an employee benefit for purchasing stock at discount, selling the stock at regular price, taking the difference. So then for the debt, we have the credit card, we have 38,000, which it seems like and we'll get into this with the budgeting, but it seems like you're cash flowing that as best you can on a monthly basis. Okay.
Yeah, for the most part.
Okay.
Mhm.
So we currently have 38,000 on there. We'll come to like what upcoming expenses we have, but we have that. We have your mortgage, which is at a great rate at 2.85. You have 600 and roughly 650,000 on that with a home value of 1.1 million, so about 450,000 of equity in your home. And then you have student loans of 25,000 and then two car loans with really great rates at 14,000 each. And then a 401k loan of 43,000, which is at 5% that you're currently paying back. And then you are helping pay your child's student loan interest while they're in
Correct.
school, which I'm teaching a
Correct.
class coming up. We're going to advertise. I'm teaching a class for the Illinois library system on student loans. And so few people realize that the interest can be, depending on the loan, accruing the entire time you're in school. They're just adding it into the
Correct.
principal and then recalculating the interest, which is
Correct.
the opposite of compounding of interest. It's like the exact opposite of what you want to happen.
It
So
is the worst scenario because it just rolls into the principal.
yeah, it's called capitalization of interest, and you're paying interest on interest. It's like loan shark math, is the only way I could describe it.
That is why I still have student loans.
Oh, because of the interest on the interest? Because yeah, I was going
It,
to ask
it
about your
is
student loans.
it is at least a very significant factor in that, yes.
Yeah,
Because the amount that I borrowed was significant because I used it for my flight training, but the amount that I owed was massive.
was significantly different than what you borrowed because of how they calculate the
Absolutely.
interest. Yeah, so this is why we're
Yes.
teaching the class. So if you have student loans, you should check out our Instagram. We will post when I'm teaching this class. It's April 7th with the Illinois Library System. It's virtual and it's free. But the issue with student loans is if it was just a set amortization schedule, like for instance, your mortgage, which right
Mm-hmm.
is like 650,000 at a
Mm-hmm.
reasonable rate and on a schedule where you're paying both principal and interest every month and
Yes.
eventually more principal, you could pay it off. But the problem with these loans is it's interest on interest on interest on interest, and no one's ever
Correct.
even hitting principal, and they have no idea they're not hitting principal for like decades.
And to make matters worse, because of my industry, it is so expensive expensive to get into the industry first off. And then I came out around the 2000s. So I came out of school and I got hit with 9/11. And then I got furloughed. I've been furloughed, I want to say 3 or 4 times, and companies go out of business and they do all this stuff. So I went for extensive periods of time where I spent over a decade not having steady work, let alone any kind of significant paycheck. So every time I went through this, at the time, it was much more common where airlines had this cyclical business cycle.
Yeah.
And you would get laid off fairly routinely, especially as pilots. And so when you get laid off, I can't afford to make my payments. And if you're out of employment, you can do forbearance. You could do all.
I was going to say, you were doing forbearance on your loans?
Extensively. I was living on couches extensively. So I certainly didn't have any money to pay back these loans. So I would just put them on forbearance or deferment
and the interest, your interest is still cooking.
Over and over and over. Correct.
So can I ask you, what did you actually originally take out as your principal amount for a student loan?
This is decades ago.
Okay.
So I want to say it was relative to $120,000. It had to be right around there.
And how old were you when you took out that amount?
Well, I went to school a little bit older, so I want to say I was 20.
20.
I was 19, 21.
Okay. And so you're 48 now. So you've had these loans for 28 years.
Correct. Never missed a payment. Never did a late payment. Maybe in the course of time I did one. But as far as I know, I've never been late. I've never done anything. I've just repaid on time, and I still have these loans. Correct.
Which is very interesting because how your mortgage is is your mortgage a 30-year fixed?
Yes.
And what was the original amount you took out for that on your mortgage?
Oh boy. $650, I want to say.
Okay. So $650 in 30 years versus $125 in basically 30 years, right? If you think about it, like that's where but that's, I mean, think about it. You're spending you're going to have 30-year mortgage and you're going to pay off about $650,000. Now the interest rate is different, but not like, it's not one's 25 and one's 2. It's like 2 to 5, right? So it is definitely a different interest rate, but $125,000 because of the way they structure the loan payments. Think about that. That's insane.
It is. It is completely insane.
Yeah. Which is why we're teaching a class on it, because people don't understand it.
And I will get my daughter to sign up for it. So definitely give me the link for it.
Definitely give me the link for it. Okay, so you're almost done with the student loans, which is good. But
it is on the way down, and every time we get hyper annoyed by them and think, let's just focus on them and get rid of them, there's all these other priorities that come out of the woodwork.
Yes. So we're gonna get to the priorities. Okay, so we have a little bit of student loan debt. We have the 401k at 43, and then you are paying your child's interest, which is like honestly the greatest gift you could give, because it, as you know firsthand, what you borrow, right? What you're borrowing versus what you're going to owe at graduation could be a dramatically different amount just because of the capitalization of interest. So you're paying the interest for your child, which is a great gift.
I just don't want her to get caught in the same trap.
No, yeah. And the thing is, most of the time, like if you did a standard repayment with the student loans of 10 years, you can get them paid off. The problem is nobody signs up for the standard repayment, or no one even knows. And I'm like, what repayment program are you on? And people are like, well, I just make a payment. I'm like, is it 10 years, 25 years? Or what are we, principal versus interest? No, it's like the process is so convoluted and not transparent. It's difficult. But you're really giving her a leg up by like, whatever was borrowed is what she'll start with when she graduates, which is great.
And it's going to be significant. Flight training can easily, if you get through your flight training under $100,000, you were amazing.
Is she going to flight training?
Yes, she is. I'm sorry, I don't think I mentioned that.
Yeah, that's okay. I was just hearing.
She is.
What I always tell people, like especially if you know that you're going to have really good income and you're going to spend 100 to make 4, good investment, right? It's
right. Absolutely. It's like doctors, you don't make that. Oh, I got the thing. I'm done. So when you go, oh, I just want to do a standard payment, and they go, what's my payment going to be? You're like, well, it's going to be $800 or $1,200. You go, that's what I make a month. And so you can't just do a standard payment because in the beginning you literally cannot pay that.
Right. So you have to do one of the others, but then you want to be careful about the interest and you want to understand that if you're getting a
Right.
tax refund or a bonus, that you're putting a principal only payment on that to try to tackle that capitalization of interest so that it doesn't get crazy or refinance. Right now we don't have great rates for
Right.
refinance, but back in the day, we had low interest rates. A lot of people refinanced at 2 or 3% for their loans on a
Right. That's why we have the mortgage and the cars and everything are right around 2%, is because
because
that's exactly what we
refinance.
did.
Yeah, which is great
Yes.
because those were wonderful numbers. And I know people are waiting for those rates to come back. I don't know if we'll ever see them again.
I think the once in a lifetime rates probably won't come back.
Yeah, that's my guess too. But you never know. There's always a slim possibility.
I know many
Okay.
people thinking the same thing. Yes.
Yeah, they're like, I'm just going to buy a house when we get a 2% mortgage. And I'm like, well, statistically, it's never happened before. It's not to say it couldn't, but it would be rare. Okay, so total debt, including mortgage, with everything added in, we have 744,000. I'm not including the credit card debt because it does seem like you cash flow that, so I don't have that necessarily in there. So you have good income, you have a good amount saved for retirement. So really what it comes down to is cash flow, right? Like that's, I think, where
Okay.
the issue is. And I know you said this in the email, and the one thing that I would like you to have that you don't have, which you already know about, because you said it in the email, is I would like for you to have an emergency fund. And
I
I know you have a
understand.
plan for emergencies. I know that you have a plan. Emergency funds are, yeah, they're very boring. They're not very exciting, but they are
Correct.
good. And here's what I'll say is it's very good to have an emergency fund going into retirement. I get very nervous for individuals who are really ready to pull the plug for retirement who don't have an emergency fund because it's almost like that's when the emergency happens, you know? It's like something like random, like a tree falls down, like in a storm, and then like you have to hire what they call tree surgeons. And the reason they call them tree surgeons is because they're so expensive. Um,
I
and
understand.
so stuff like that. So we'll talk about that. But yes, an emergency fund is something I'd like to see for you in the future. Okay, so let's talk about cash flow and lifestyle. So the credit
Yeah.
card debt comes from what you've explained to me, comes from you have big expenses that are coming up on a regular basis and you're putting them on the credit card, and then as you have extra cash flow, you're paying them off. But it feels okay to me, it feels a little overwhelming. How does it feel for you with the credit card and the cash flowing in?
It feels fine managing it because I enjoy it.
Okay.
I do monthly budgets and everything. I have what's called a budget book, and I mean it's a joke in the family now and everything. Um, but I enjoy it, so I don't feel overwhelmed by it.
Okay.
Or people who go, I just want to deal with finances once a month. I like it, so I don't mind it.
You don't mind it.
Um,
Okay.
no, the problem becomes is that I make my plan and everything is the numbers all work out and then it gets blown up.
Okay. I could see that. Okay. So
Probably you.
yeah. So one line item that you don't have in your expenses that I noticed is you don't have an auto savings plan.
I don't. You
Okay.
are correct.
Okay. I would just, because you could, so with the Ross, for instance, with you maxing out at 50, total for household at 15,000, those could be automated. So that could be, so my suggestion with looking at it would be automating some of your savings and some of the goals that we'll go through what your goals are. Automating it and treating it more like a bill might be helpful. Doesn't always work for everybody, but saying at the beginning of the month, like it is a priority because we're targeting X for retirement. We want to make sure those Roths get done, and then it's little bites instead of having to cash flow it at 7,000 and 8,000, which is like all of your disposable income for 2 months, right back to
Correct.
back. If you think about it from that perspective, might be a better way to do it if the money just, this is how I did it with my sister because like she was the same way, right? So if you auto it and you treat it like a bill, because it is a bill, right? Like the goal is that we retire. You have a mandatory retirement. Your husband's already retired. So then it should be as much of a priority as everything else, right? Is the way I would look at it.
Yeah, I would have done that a long time ago, but with a revolving credit card debt, I always go, well, shouldn't I be paying that first?
Hmm. I would argue with what you have left over monthly. So
Yes.
there's two things I would say is I think it would be a good exercise to try automating some of the savings and treating them more like a priority where they get paid first. Just because in that way, if you're checking your budget throughout the month and you're saying like, okay, we want to go do XYZ, and it's like, well, we only really have 4,000 left in the bank account. Like maybe we should not do that because we want to these. I think what you're looking at the budget and the numbers, it seems like you're enjoying the income, which you worked really hard to get to. You spent a lot of money to get to this profession and you're working hard. And so you want to enjoy the lifestyle aspect of it, but we also have these goals of where we want to be in the future in retirement, right?
Mhm.
And this the great thing is you're getting a ton of money in your 401k match. Like as I said, I've never seen such a large amount. But I do think that putting yourselves first in terms of where you want to see your future self would be important. Where you're saying, okay, it is a priority that we have over 100. Well, we want to do almost $1 million in Roth, which is attainable based on the numbers I've mapped out if you're maxing out those contributions every year.
Right. Yeah, we have to max them out.
Yeah. And then the numbers are great. But if you're missing years here and there because other things have popped up, then those numbers won't be as good just because like the compounding of interest effect, like just we won't have as much money going in
Yeah.
and as much money growing. The one trick I will say about the monthly contribution for you specifically is the conversion feature of it. For you, technically, it is easier to do one transaction, one contribution, one conversion. So
Understood.
you could also put that money, it's like a trick, but you could put that money into like a separate bank account, out of sight, out of mind, the regular amount, and then make the one-time contribution, but you've already pre-funded it as a regular bill, like an expense. And then
Right.
that way it's definitively there for you for the future. And then you can do the one time for your husband, the one time for you, and the conversion. So you don't have to worry about it's too much work, in my opinion, to do it monthly, but you could trick yourself in saying there's a monthly bill, it gets sent to this bank account at, the end of the year. That's what I use to fund max out those two accounts. I think
Okay.
that'll work for you because you're doing the 401k, right? Like the 401k money is coming out of your paycheck, you're getting your net, and then relative to what your income is, setting aside the monthly amount for the Roth into a separate bank account so that that money's earmarked and always there, I think would be a good strategy to try.
Okay. I think that's doable. I think we can make that happen. Especially, like you said, especially with my husband's Roth. That's like a no-brainer.
Yeah, it's a no-brainer. Yours is a little more complicated because it's a two-step, but you could send
Sure.
it to a bank account. I think the auto save is a really powerful tool, um, so that the money is ready to be invested and it's set aside and not in your regular bank account because I think that's where things disappear, right? Like at the end of the month, you're
Exactly.
like, yeah, I know, I know.
And
You're like,
that's
I'm
honestly
not.
when you're talking, everything that you're saying is completely logical. But if I keep putting away several $1,000s, and let's say at the end of the year there's seven or $10,000, I am afraid it will get spent.
Yep. So that's what we're gonna talk about. So we're gonna talk about like okay, how do we get to where you want to go and still live the lifestyle you want? Because I think that's what you're like. I think that's the issue at the moment, right? It's like,
I believe so.
yeah, because
That I believe that's
your
the
income is
whole
good.
issue. It's wonderful, and it's like you said, we have it's amazing, and then we look at it and go, I don't understand why we can't go to the island for this weekend, and yeah, it'll be $1,000. What's $1,000?
Thank you so much for tuning in with my conversation with Kay. This is a two-part episode. So next week on May 9th, we will continue our conversation and you can hear how everything plays out with Kay. Thanks for listening. Time for our disclaimer. The opinions voiced in this podcast are for general information only and not intended to provide specific advice or recommendations for any individual. All performance references are historical and do not guarantee future results. Make sure that you consult with your own legal, tax, and or financial advisor before making any decisions.